The Federal Deposit Insurance Corporation, or the FDIC, is an independent agency created by Congress to maintain stability and public confidence in the nation's financial system. So if it's their job to prevent a bank run or to stop one from happening to begin with, then just what in the hell is the FDIC doing maintaining a controlling interest in thousands of dilapidated, rent-controlled apartment buildings all over New York City? And considering that we're less than a year removed from the second, third, and fourth largest bank failures in U.S. history, and that the FDIC has just $119 billion available to guarantee over $9 trillion of bank deposits, why then are they accepting bids for just 58 cents on the dollar for the debt against these buildings, especially when more competitive bids at 80 cents on the dollar are also on the table? Surely this has nothing to do with ostensibly charitable organizations run by people who just happen to pay themselves 6 and even 7-figure salaries while making backroom deals with corrupt politicians. And don't call me Shirley. What's up, guys? I'm nobody special, and last week, while the mainstream financial press was bloviating about stocks making new all-time highs and artificial intelligence, and oh my goodness, big tech earnings were so wonderful, there may have been another bank crisis starting here in the U.S. Several banks from all over the world reported massive losses from U.S. commercial real estate last week, starting with this one, New York Community Bank. Now, New York Community Bank reported losses from office towers, but they also reported large losses from multifamily residential real estate, in particular, rent-controlled multifamily real estate. According to TheRealDeal.com, New York Community Bank hiked its provision for credit losses and estimation of unrecoverable debts by 790% from the previous quarter to $552 million. The bank reported a near $2 billion increase in criticized multifamily loans, or debt with a high probability of default. Of its $37 billion multifamily loan book, which comprises 44% of its total portfolio, 8% was marked as criticized in the quarter. Now, if New York Community Bank sounds familiar to you, it should, because they were heavily involved in last year's collapse of Signature Bank. After Signature Bank failed following the collapse of Silicon Valley Bank, and they were taken into receivership by the FDIC, who seized all of their assets and began to sell them off, NYCB was one of the banks that stepped in and bought most of those Signature assets. But I remember at the time, noticeably absent from those assets that were purchased by NYCB was any of the loans against rent-controlled multifamily real estate in New York City. Signature was the largest holder of debt written against rent-controlled buildings in New York City, and NYCB was the second largest. And so when I read last week that New York Community Bank was having trouble because of those rent-controlled buildings, it made me wonder whatever happened to those Signature Bank loans against those same rent-controlled buildings. And it was at that point that I remembered a conversation I had a few weeks ago with Melody Wright about the auctions for Signature Bank's rent-controlled assets and how there was some suspicious activity that was going on there. And that led me to this article in The City. Signature Bank portfolio sold in 2 deals that could preserve affordable housing. The FDIC will maintain controlling interest in $15 billion in mortgages once held by the failed bank as it turns to Santander and a community-focused consortium to manage loans covering hundreds of buildings across the city. In an effort to keep tens of thousands of rent-stabilized apartments out of the reach of questionable lenders, the FDIC on Wednesday concluded the second of 2 massive deals that leave it with controlling interests in $15 billion of mortgages across New York that were once held by Signature Bank, the victim of a stunning cryptocurrency-induced collapse in March. Until it crumbled in the 4th largest bank failure in American history, Signature was the largest lender to rent-regulated buildings across New York. Its collapse led to fears that the FDIC could auction the mortgages to financiers intent on encouraging landlords to push out lower-paying, stabilized tenants or to scrimp on maintenance to meet their loan payments. So if the FDIC, for whatever reason, didn't want to sell to questionable lenders, who did they actually sell to? That led me to this article in Multi-Housing News. CPC related JV buy stake in 5.8B Signature Bank portfolio. My, look at all those letters. CPC stands for Community Preservation Corporation, and their related joint venture bought a stake in a $5.8 billion chunk of those Signature Bank rent-controlled apartment buildings from the FDIC. A partnership led by the Community Preservation Corporation alongside Neighborhood Restorer HDFC and related fund management has entered a joint venture with the Federal Deposit Insurance Corporation to acquire a 5% stake in a $5.8 billion rent-stabilized and rent-controlled multifamily loan portfolio retained after the failure of Signature Bank. The partnership paid $171 million and will act collectively as the community stabilization partners. The FDIC will maintain 95% ownership. So there is a lot being said here. First of all, the main thing, the FDIC will retain 95% ownership. The Federal Deposit Insurance Corporation's mandate is to protect the stability of the financial system, to maintain public confidence. And so in order to do that, they seized all of Signature Bank's assets and put them into receivership. And then they dipped into the Deposit Insurance Fund and gave all of Signature Bank's customers their money back. So now they're left trying to sell those assets that they seized to recover as much money as they can to replenish the Deposit Insurance Fund. So why then are they maintaining 95% ownership of this $5.8 billion loan portfolio against these dilapidated buildings? And I would also add that this joint venture being led by the Community Preservation Corporation paid just $171 million for 5% of that $5.8 billion portfolio, which means they're only paying 58 cents on the dollar for the debt against these buildings. They're getting a huge discount here. And it's that huge discount that has some people crying foul over what the FDIC just did. Check this one out in globestreet.com. Brookfield claims FDIC ran secret auction for Signature Bank. Brookfield Property Group claims the FDIC ran a secret sales process for the loans of Signature Bank, according to a Financial Times report. We have heard from numerous sources, including from your advisor Newmark and from media reports, that a winning bidder has been selected and that this bidder's price is lower than ours, Brookfield said in a letter addressed on December 7th to the FDIC, as seen by the Financial Times. The Wall Street Journal reported in November that a combination of two nonprofits and related fund management had won the bid for less than 70% of the loan's face value. It was actually 58% of the loan's face value. And according to the Financial Times report, Brookfield had bid 80 cents on the dollar. So the FDIC turned down a much larger bid from Brookfield and opted instead to take a lower price to sell to this joint venture run by the Community Preservation Corporation. And the FDIC is stating that they did so to prevent, quote, questionable lenders from taking over these loans. And of course, that had me wondering, why would the FDIC even care? Here's the mission statement from the FDIC's website when they say that their mission is to ensure public confidence in the financial system by ensuring deposits, examining and supervising financial institutions, making large and complex financial institutions resolvable, and managing receiverships. I don't see anything there about affordable housing in New York City. That is until you look at Chapter 12 of U.S. Code Section 1823, where it lists all of the FDIC's priorities in the disposition of assets. Those priorities are maximizing the net present value return for the sale and disposition of those assets, i.e. making sure they get as much money back as possible. 2, minimizing the amount of any loss realized in the resolution of cases. Again, make sure they recover as much money as possible. 3, ensure adequate competition and fair and consistent treatment of offerers. That's something they definitely didn't do when they declined the far superior bid of 80 cents on the dollar from Brookfield. Section 4, prohibit discrimination. And Section 5 is where we run into trouble here, maximizes the preservation of the availability and affordability of residential real property for low and moderate income individuals. And in the case of this auction of Signature's assets, the FDIC chose to ignore priority 1, 2, and 3, and instead decided to focus on priority 5. So in this case, the FDIC turned down tens of millions of additional dollars that could have been recovered in order to replenish the Deposit Insurance Fund, which guarantees bank deposits in this country. They chose to decline that extra money in order to preserve the affordable housing in New York City. Okay, so if Brookfield was one of those questionable lenders that we didn't want to let them get their hands on the debt against these buildings, then I have to ask, who are these people that were not questionable? Who was this Community Preservation Corporation, and why were they chosen at 58 cents on the dollar when Brookfield was turned away at 80 cents on the dollar? Well, it turns out the Community Preservation Corporation is a 501c3 nonprofit organization who, at least on the surface, appears to have the singular focus of providing affordable housing to low and middle income individuals in New York City. Here from their website, their mission is CPC believes housing is central to transforming undeserved neighborhoods into thriving and vibrant communities. CPC is a nonprofit affordable housing and community revitalization finance company providing flexible capital solutions, fresh thinking, and a collaborative approach to the complex issues facing communities. Well, gosh, that just makes me feel all warm and fuzzy inside. Look at all those wonderful words and feel good in communities and revitalizing and affordable. So many words that I'm sure tested very well in focus groups. I guess I should stop looking and certainly not dig into the financials of this outfit, right? And once again, everything would have been just fine if Jack had stopped reading and didn't dig into the numbers at all. Check this out in ProPublica.com, where they list some of the compensation packages for the executives and officers at the Community Preservation Corporation. Remember, this is a 501c3 nonprofit charity. CEO, President, and Director Rafael E. Sestero, he made $2.3 million for managing this charity in 2022, the latest year we have data available. My granny, what big not profits you have. But it's not just Rafael Sestero and his $2.3 million compensation package that he gets for running this charity. There are at least 10 other executives at this charity bringing home more than $500,000, and there is another 20 on top of that who are bringing home at least $200,000 or more. Remember, this is supposed to be a charity. There's a lot of people taking home a lot of profit at this not-profit organization, people who are being paid very handsomely to provide affordable housing to the people of New York. And how's that going, by the way? Now, let's say, hypothetically, we had a free and independent financial media in this country, and they ever bothered to ask questions of the executives of these charities that are bringing home 6- and even 7-figure salaries. I'm sure we'd get pre-prepared statements about how proud they are of the work this nonprofit is doing and their long, storied history of helping the disenfranchised, history that includes this article from March of 2012 in the New York Times, lured by visions of real estate profits, nonprofit group stumbled. And I couldn't help but notice that they mention profits in the headline about this nonprofit organization. At the height of the housing boom, a luxury development arose here that was carved out of a 19th century brick and brownstone factory building with 14-foot ceilings, oversized windows, and granite countertops. Like many similar condominium projects, this one collapsed with the recession, but the damage rippled far beyond this historic city because of the project's main financial backer, one of the most illustrious nonprofit housing groups in the nation, and you guessed it, the Community Preservation Corporation, which for decades has played a pivotal role in the reviving of downtrodden neighborhoods across New York City, has teetered at the brink of collapse in recent months after it strayed from its traditional mission. Community Preservation, established in 1974 at the initiative of the banker David Rockefeller, had long used capital that it raised from scores of commercial banks to finance the creation or rehabilitation of rent-regulated multifamily apartments for the poor and working class. But during the boom, it was instead pouring hundreds of millions of dollars into condo projects and large-scale development. It did so in part through an unusual for-profit arm. There's that nonprofit making profits again. The investments were spearheaded by Community Preservation's then longtime leader, Michael D. Lapin, whose salary and bonuses rose to $1.1 million as he pushed the group into riskier ventures. I guess the joke's on him because the new guy's making $2.3 million. At the peak of the real estate boom in 2007 and 2008, more than half of the $1.5 billion in loans originated by Community Preservation or its for-profit arm were for condos. Community Preservation also provided a $23 million loan for a luxury condo project called Metroplex on the waterfront in Rockaway, Queens. The 126 apartments had balconies with ocean views, oak floors, jacuzzis, and a gym, but when the project opened, not a single one sold. And I wonder how many of those places with ocean views, jacuzzis, and gyms went to rent-controlled, subsidized tenants. In 2007, more than $150 million of those loans were in default and community preservation was in crisis. Its board and the commercial banks that supported it forced Mr. Lappin into retirement. He was replaced by Rafael Sestero, who's now making $2.3 million. Nearly two-thirds of the condo loans were delinquent, according to the nonprofit's records. So long story short, the United States may be on the brink of another bank crisis, or maybe this is really just a continuation of the crisis that started last year that never really ended. Either way, that's an unimportant nuance. We've got New York Community Bank that's now in big trouble because of these rent-controlled apartment buildings. That's the same New York Community Bank that bought out Signature Bank's assets last year, but noticeably absent from those assets that they bought was any additional rent-controlled multifamily residential real estate. The FDIC still maintains a controlling interest in these loans, which are backed by thousands of rent-controlled buildings all across New York City. They were only able to sell a 5% stake in these buildings, and they did so at 58 cents on the dollar, while ignoring superior bids for 80 cents on the dollar because they're claiming that their real goal here is to preserve affordable housing, and so they're siding with this CPC, which pays their executives very generous salaries, including $2.3 million to their CEO, the same CPC that has a history of blurring the lines between charity and for-profit when they lent hundreds of millions of dollars to luxury condo apartments that went belly up in the GFC. And now the FDIC is getting into bed with these guys, all so that they can accept less money for these assets while pretending to care about affordable housing. And by the way, the people who live in these affordable housing units, does life ever get better for them? All of these people who are making $200,000, $300,000, $500,000 a year, $2.3 million a year, all of these government-lettered organizations and nonprofits and phony philanthropists who are there pigging out at the trough collecting generous salaries, does life ever get any better for the people living in these buildings? Or is this just another case of politically connected individuals and crooked bankers pigging out at the expense of the little guy, all while being told it's for your own good? And all the while, the FDIC is down to just $119 billion in the Deposit Insurance Fund that's there to protect $9 trillion in bank deposits. And if it comes down to another crisis, it's very possible that we'll go into the Deposit Insurance Fund and instead of finding money, well...
What is this? What is this? Where's all the money?
That's as good as money, sir. Those are IOUs.
And well, that $119 billion in the DIF could be a little bit bigger, but instead of selling those assets, the FDIC decided that they want to just hold on to this IOU $5.8 billion from this community preservation group.
Might want to hang on to that one.
Till next time, live small and dream big.